Welcome to this week's series of Credent Connect. And today we want to revisit some of the economic data points released over the past 3 to 4 weeks as a function of gauging the benefits, or rather the intentions of the Federal Reserve's higher for longer interest rate backdrop that we've seen here in 2023 and 2024. And one of the interesting things here that transpired is not only data on the labor market to showcase some of the softening components of the labor market, which is a positive, but also on retail sales front, and eventually what may bleed over into gross domestic product or GDP growth, economic growth. And one of the very interesting things we're observing right now is obviously the eventual recession is forthcoming, right? Forthcoming may mean 3 months, 6 months, 12 months, 24 months, whatever the case may be. But one of the things that we want to focus on, or touch on rather, is the fact that as of today, the New York Federal Reserve Bank is estimating a 50% chance of a recession over the next 12 months. This indicator has been fairly robust over time, but what's interesting to note is that that 50% number is notably higher by almost double than it was in the Great Financial Crisis, than it was during COVID, than it was during the tech bubble of the early 2000s. So we would kind of classify that as slightly overrated. Alicia, on that front, as we look at those retail sales numbers and the labor market and earnings backdrop so far this year, relative to what's happening with the Federal Reserve, right? Tightest Fed in 40 plus years at this point. How has that data transpired with the interest rate backdrop? Where are we headed? Should we be that worried at this point in time?
Sure. So starting with the earnings backdrop, what we've seen so far year to date with earnings is that they've come in significantly better than expected. So we're talking to double the earnings growth that was anticipated. And I think that really shows that a couple of things. One, companies are able to continue to grow their revenue and continue to maintain margins. They're continuing to use AI and other sources of productivity to keep their earnings high. So companies are doing really well. But two, so are consumers. When we look at consumers, at least the upper end of the consumers, they have a lot of cash. They're continuing to spend. I think if you look at any economist, they are surprised that consumers have been this resilient.
Right.
But to your point, we are starting to see a little bit of prudence within consumers. And we saw that last week with retail sales. We're seeing that goods spending is kind of slowing a little bit. And when we look at some of the earnings releases that have come out, we've seen that. So Starbucks, some of those, discretionary Home Depot, we're starting to see that spending kind of slow. But then when you look at, let's say, Walmart, for example, their earnings came in really strong because consumers are starting to spend more on the staples and those sort of things.
Sure.
So I think when we look at the consumer relative to other recessions, still very strong, even though we're starting to see the labor market kind of starting to slow. So we're starting to see job openings come down. We're starting to see the unemployment rate tick up higher. But to your point, that's what the Federal Reserve is expecting.
Yeah, so the intended consequences are actually positive, not really negative in this point in time, right? I know it's hard to actually look at that on a forward-looking basis and say that's positive, but that is the real intention. I also want to point out that we've touched in the past through this Credent Connect series, the fact that the headlines are stating appropriately and accurately that savings rates have dropped to almost zero. Absolutely true. But savings rates are only a function of today, has nothing to do with what has been accumulated over the past. We're still seeing excessively high savings amounts, right? We're seeing money market assets at roughly $3 trillion above pre-COVID levels. So in aggregate, yes, current discretionary spending may be slowing down on a relative basis. The accumulation of that backdrop from a savings amount across consumers is really fairly high to this day. I also want to point out the fact that every time the probability or discussion of a recession does arise, there's this notable fascination across markets that recession is coming. It is a normal phenomenon, okay? It is a function of how capital markets work. It's a function of the business cycle. Managing through that recession, not trying to time the recession, right? With various risk management techniques, risk management tools, cash management options, all those when put together are the best approach to tackling a recession, not getting out of the market, not making a bet on the market, not making a bet on interest rates and duration and bonds and stocks. So it is a very well orchestrated chess match at this point in time. As it relates to bonds on that front, right? I think the natural inclination is surely bonds will be a value add in this case relative to equities during a recessionary backdrop. Alicia, where are interest rates today? Kind of what are our views on the fixed income environment as a means of trying to overweight that segment in hopes of missing any downside on the equity side?
So as far as rates today, rates are high, and that's given that the Federal Reserve has interest rates at the highest level that they've had in many years. So we do have some really strong allocations across the board in T-bills, about 7 or 8% across our equity sleeve. And that really provides us with some ballast in the situation where we do go into a recession and we see a lot of volatility. But when we look at the long term, we know that equities is the place to be for long-term growth and to keep up with inflation. So even though bonds are a good place to provide some of that ballast, it's not a place to be where you want to go out of equities and go into fixed income for the long term, because we know that equities is where you want to be for that long-term growth. And most of our clients have a long-term time horizon. So that's really where we want the majority of our assets to be. But of course, we're going to allocate across bonds for, to satisfy those investment objectives of our clients.
Yeah. It's funny, if you go back even 18, 24, 36 months throughout these series of videos, you will note that one of the adamant kind of talking points, one of the things we've been honing in on is the fact that bonds carry more risk than stocks over the long term. And we were discussing that fairly in depth, even during COVID, even right after COVID. We still think that is the case, right? From a longer term horizon, net of inflation, bonds do carry that greater risk. We urge caution in that. The yield-seeking income environment is great today. I think overplaying that trade may result in more risk than simply accepting a very controlled and appropriate equity market participation profile.